On March 19, 2023, a bank that had survived 2 world wars, the Great Depression, the 2008 financial crisis, and 167 years of economic turmoil, disappeared in 72 hours. Not a small regional bank. Not a risky startup fintech company. We're talking about Credit Suisse, the second largest bank in Switzerland, a country so synonymous with banking that we literally use Swiss bank account as shorthand for financial security. Here's what doesn't make sense. Credit Suisse wasn't some reckless American investment bank gambling with subprime mortgages. This was Switzerland. The country where banking isn't just an industry, it's a national identity. Where financial stability is protected more fiercely than the borders themselves. And yet, in the span of one weekend, Credit Suisse went from being a global financial institution managing $1.4 trillion in assets to being sold for $3.2 billion, less than the value of a single office building in Manhattan. That's not a bailout. That's a fire sale. But here's the question that should keep you up at night. How does a 167-year-old institution, operating in the world's most stable banking system, with armies of risk managers, auditors, and regulators watching every move, how does it implode so spectacularly that it nearly takes down the entire European banking system with it? The answer isn't what you think. This wasn't a story of a single catastrophic mistake. It wasn't a rogue trader or a surprise market crash. What destroyed Credit Suisse was something far more insidious, something that's happening right now at other banks you trust with your money. Because here's the terrifying truth. The warning signs were visible for over a decade. Regulators saw them. Investors saw them. The bank's own executives saw them. And everyone did nothing. Or worse, they did exactly the wrong thing at exactly the wrong time, in a pattern that repeats itself with clockwork precision throughout financial history. By the end of this video, you're going to understand not just how Credit Suisse failed, but why its collapse reveals a fundamental flaw in how modern banking works, a flaw that didn't disappear when Credit Suisse did. In fact, the forces that destroyed this bank are still operating today, hidden in the balance sheets of institutions you probably think are too big, too old, or too important to fail. So the real question isn't, what happened to Credit Suisse? The real question is, which bank is next? Let's find out. Before we dive into how this all unraveled, you need to understand the people who were pulling the levers when everything went wrong. Brady Dugan was CEO from 2007 to 2015, the man at the helm during the 2008 financial crisis and its aftermath. Unlike many of his peers, Dugan kept his job after 2008, positioning himself as the steady hand that guided Credit Suisse through the storm. But as we'll see, the decisions made during his tenure planted seeds that would germinate into disaster years later. Tidjane Thiam took over in 2015 with a mandate to transform Credit Suisse from a risky investment bank into a stable wealth management powerhouse. A former insurance executive with no banking background, Thiam was supposed to be the outsider who would fix the cultural rot. Instead, his tenure ended in a surreal spy scandal involving private detectives tailing executives through the streets of Zurich, a scandal that sounds too bizarre to be real, but we'll get to that. Thomas Gottstein became CEO in 2020 after Thiam's dramatic exit, promising a return to stability. His tenure lasted just 2 years. 2 years that would see Credit Suisse lurch from one disaster to another with accelerating frequency, culminating in losses that erased a century and a half of accumulated trust. But the most important figure in this story isn't a CEO at all. It's Lex Greensill, a man whose name you probably don't know but whose company's collapse triggered a chain reaction that exposed just how fragile Credit Suisse had become. These weren't incompetent people. They were Ivy League-educated, experienced executives running one of the world's most prestigious financial institutions. Which makes what happened next even more disturbing, because if they couldn't see the warning signs, what makes you think anyone else can? To understand how spectacular this failure was, you need to understand what Credit Suisse represented. Founded in 1856 by Alfred Escher, a Swiss politician and railway entrepreneur, Credit Suisse wasn't just another bank. It was created specifically to finance Switzerland's industrial revolution, funding the massive infrastructure projects that would transform a landlocked, mountainous country into an economic powerhouse. The bank helped build Switzerland's railway system, electrified its cities, and bankrolled the industries that made Swiss-made synonymous with quality. For over a century, Credit Suisse embodied Swiss banking values: conservative, discreet, boring in the best possible way. While other banks chased risky ventures, Credit Suisse stuck to what it knew: wealth management for the ultra-rich and steady, predictable corporate banking. But here's where the story takes its first critical turn. In the 1990s, Credit Suisse had a choice to make. The world of banking was changing. American investment banks like Goldman Sachs and Morgan Stanley were generating eye-watering profits through aggressive trading, complex derivatives, and high-risk, high-reward investment banking. The fees from mergers, acquisitions, and securities trading dwarfed the steady but modest income from traditional banking. Credit Suisse looked at those profits and made a decision that would echo through the decades. It wanted in. In 1988, Credit Suisse acquired First Boston, a major American investment bank. Then in 2000, it bought Donaldson, Lufkin and Jenrette for $11.5 billion. These weren't small moves, they were a fundamental transformation of what Credit Suisse was. The conservative Swiss bank was now a global investment banking powerhouse, competing directly with Wall Street's most aggressive players. But there was a problem with this strategy, one that wouldn't become obvious for years. Credit Suisse was now playing two completely different games simultaneously. On one side, you had the traditional Swiss private banking business, managing money for wealthy families, dictators, oligarchs, and anyone else who valued discretion above all else. This business was built on trust, confidentiality, and a reputation that took 150 years to build. On the other side, you had the investment banking division, traders making massive bets, bankers structuring complex deals, and a culture that prized aggression and profit above everything else. This was the world of quarterly earnings targets, where executives were judged not by long-term stability but by how much revenue they generated this year compared to last year. These two cultures don't just clash, they're fundamentally incompatible. And Credit Suisse tried to be both at once. By 2008, when the financial crisis hit, Credit Suisse had become something its founders wouldn't recognize. A sprawling global bank with operations in over 50 countries, managing $1.5 trillion in assets, and deeply entangled in exactly the kind of complex, interconnected financial instruments that nearly destroyed the global economy. But here's the thing that makes Credit Suisse's story different from other banks that failed in 2008. Credit Suisse survived. It took government money, sure, $54 billion in emergency support from the Swiss National Bank, but it survived. Its management claimed they had learned their lesson. Regulators believed them. Investors believed them. And that's precisely why what happened next is so shocking. Because Credit Suisse didn't fail because of the 2008 crisis. It failed because of the decisions it made after supposedly learning from that crisis. The bank that emerged from 2008 was somehow more fragile, more reckless, and more disconnected from reality than the one that went into it. And the next 15 years would be a slow-motion collapse that nobody seemed able to stop, even as everyone watched it happening in real time. The seeds of destruction, 2008 to 2015. Let's start with what Credit Suisse's leadership got right after 2008. Absolutely nothing. While other banks were deleveraging, reducing their risky bets and strengthening their capital positions, Credit Suisse decided to double down on investment banking. CEO Brady Dugan's strategy was simple: grow. Compete with Goldman Sachs and Morgan Stanley for the same high-risk, high-reward deals. Generate returns that would make shareholders happy and executives rich. In 2014, Credit Suisse pleaded guilty to conspiracy to aid tax evasion for U.S. citizens, the first major bank to plead guilty to criminal charges since the 1980s. The fine? $2.6 billion. But here's the crucial detail: no executives went to jail. No one lost their job. The bank paid the fine and moved on, having learned exactly one lesson: that there were no real consequences for systematic criminal behavior. Meanwhile, Credit Suisse was hemorrhaging talent. The best traders and bankers were leaving for competitors who offered better pay and less dysfunction. What remained was a second-tier team trying to compete in a first-tier game, with predictably disastrous results. The transformation that wasn't 2015 to 2020. When Tidjane Thiam took over as CEO in 2015, he arrived with a clear mandate: fix this mess. His plan made perfect sense on paper: scale back risky investment banking, refocus on what Credit Suisse was historically good at, wealth management for the ultra-rich, and rebuild the bank's reputation. In 2019, Iqbal Khan, one of Credit Suisse's top executives and a potential successor to Thiam, announced he was leaving to join UBS, Credit Suisse's biggest rival. In a normal world, this would be disappointing but manageable. Executives change jobs. It happens. Thiam initially denied knowledge of the surveillance, but the damage was done. In February 2020, he resigned, and Thomas Gottstein, a Credit Suisse lifer, took over. The spy scandal was embarrassing, sure, but it was also symptomatic of something deeper. Credit Suisse had become an institution where normal governance and ethical boundaries no longer applied. The dominoes begin to fall, 2020 to 2021. If the story ended with the spy scandal, Credit Suisse would just be another case of corporate dysfunction. But we're just getting started. In March 2021, Greensill Capital, a supply chain finance company, collapsed. This might seem unrelated to Credit Suisse, except for one small detail. Credit Suisse had $10 billion worth of funds invested in Greensill products, which it had sold to its clients as low-risk investments. The Greensill disaster exposed something terrifying. Credit Suisse's risk management was effectively non-existent. How does a bank, a Swiss bank, invest $10 billion in products without properly vetting them? How does it sell these products to clients as safe? The illusion of risk management had replaced actual risk management. Credit Suisse had all the systems, all the processes, all the compliance checkboxes ticked, but none of it actually worked when it mattered. But wait, it gets worse. The Archegos implosion. Just weeks after the Greensill collapse, literally weeks, Credit Suisse announced another catastrophic loss. This time it was $4.7 billion from the implosion of Archegos Capital Management, a family office run by Bill Huang. Here's what happened. Archegos had been making massive, highly leveraged bets on stocks like Viacom CBS and Discovery. Huang was using something called total return swaps, complex derivatives that allowed him to control huge positions with relatively little money. When those bets went bad, the fund couldn't meet its margin calls, and it collapsed essentially overnight in March 2021. Multiple major banks had been lending to Archegos, Goldman Sachs, Morgan Stanley, Nomura, and Credit Suisse among them. But here's the crucial detail that reveals everything about Credit Suisse's dysfunction. While Goldman Sachs and Morgan Stanley smelled trouble early and quickly unwound their positions, taking minimal losses, Credit Suisse held on.
Why?
Because Credit Suisse apparently had no idea how exposed it was. Its risk systems failed to recognize that Archegos represented massive concentrated risk. Even worse, Credit Suisse had failed to notice that Archegos was using multiple banks to build the same positions, meaning the real risk was far larger than any single bank's exposure suggested. What's the common thread? Catastrophic failure of the most basic risk management principles. This wasn't bad luck striking twice. This was systemic incompetence finally being exposed to daylight. The death spiral, 2021 to 2023. After Greensill and Archegos, Credit Suisse entered what can only be described as a death spiral, and here's where you see the true horror of how bank failures work in the modern age. The losses themselves were bad, over $5 billion combined, but they weren't existential. Credit Suisse was still a massive bank with hundreds of billions in capital. What killed Credit Suisse wasn't the losses. It was the loss of confidence. In October 2022, Credit Suisse announced its most dramatic restructuring yet. It would essentially split itself apart, spinning off its investment banking division and refocusing entirely on wealth management. This was an admission that the 30-year strategy of competing with Wall Street had been a complete failure. But by this point, none of it mattered. The bank had lost something that's impossible to buy back: trust. By late 2022 and early 2023, Credit Suisse was facing a classic liquidity crisis. It had assets, lots of assets, but it couldn't turn those assets into cash fast enough to meet the flood of withdrawal requests. And this is the nightmare scenario for any bank, the moment when the fundamental mathematics of fractional reserve banking work in reverse. Days later, Saudi National Bank, Credit Suisse's largest shareholder, which had invested $1.5 billion just months earlier, announced it would not provide any more financial support. The chairman stated they couldn't invest more due to regulatory limits, but the message to the market was clear: even our biggest backer won't save us. That was the signal everyone needed. Credit Suisse's stock price collapsed by 25% in a single day. Its credit default swaps, essentially insurance against the bank failing, spiked to levels not seen since the darkest days of 2008. Social media exploded with posts about Credit Suisse's imminent collapse. And depositors, able to move money with a few clicks on their phones, rushed to withdraw their funds. The death spiral had become a death vortex. The weekend that ended 167 years. On the weekend of March 18th to 19th, 2023, Swiss regulators faced a choice. Let Credit Suisse fail and risk systemic contagion throughout the European banking system, or force an emergency merger. They chose the merger. In a deal negotiated over a single weekend, UBS, Credit Suisse's historic rival, agreed to acquire Credit Suisse for 3 billion Swiss francs, about $3.2 billion. To put that in perspective, Credit Suisse's market cap had been over $50 billion just 2 years earlier. The Swiss government provided $100 billion in guarantees and liquidity support to make the deal happen. Shareholders were nearly wiped out. And most controversially, $17 billion in additional Tier 1 at 1 bonds that investors had been told were safe, were written down to zero, meaning those bondholders lost everything. This wasn't a rescue. This was a controlled demolition of a 167-year-old institution, carried out in 72 hours because waiting until Monday morning might have triggered a global financial panic. If you think Credit Suisse's collapse is an isolated incident, you're not paying attention. The same patterns that destroyed this bank are visible right now across the financial system. First, consider the risk management failures. Credit Suisse's problem wasn't that it took risks. All banks take risks. Its problem was that it had no idea what risks it was actually taking. Sound familiar? In 2023, Silicon Valley Bank failed for similar reasons, holding long-term bonds without hedging against interest rate risk, a mistake so basic it's taught in freshman finance classes. The pattern repeats. Banks with sophisticated risk management systems, armies of analysts, and regulatory oversight somehow fail to spot risks that, in hindsight, were obvious to everyone. Second, look at the speed of collapse. Credit Suisse went from troubled but stable to extinct in 72 hours. Silicon Valley Bank collapsed in less than 48 hours. In the age of digital banking and social media, bank runs don't happen slowly anymore. They happen at the speed of a tweet. When confidence evaporates, it evaporates instantly and completely. Third, consider the too big to fail problem. Credit Suisse was supposedly too important to the global financial system to fail. It had over 50,000 employees, operated in dozens of countries, and managed trillions in assets. And yet it failed anyway, requiring an emergency government-backed merger to prevent systemic collapse. This should terrify you because there are other banks, Deutsche Bank, with its $1.3 trillion in assets and history of scandals, HSBC, repeatedly fined for money laundering, even major U.S. regional banks with similar risk management blind spots that carry the same warning signs Credit Suisse displayed for years. The uncomfortable truth is that modern banking has become so complex, so interconnected, and so reliant on confidence that we've created a system where catastrophic failure is not just possible but probable. We've built financial institutions that are simultaneously too big to fail and too big to save. And here's the data point that should keep you awake at night. According to the Financial Stability Board, there are currently 30 globally systemic important banks whose failure could trigger worldwide financial crisis. Every single one of them operates with similar risk management frameworks, similar regulatory oversight, and similar cultural incentives as Credit Suisse. The question isn't whether another bank will fail. The question is when, and whether next time the governments will be able to contain the damage. So what can we learn from Credit Suisse's spectacular implosion? Takeaway 1. Size and history don't guarantee survival. Credit Suisse survived 167 years of economic upheaval, only to be destroyed by basic failures in risk management and governance. No institution is too old or too big to fail when its foundation rots from within. Takeaway 2. Warning signs mean nothing if no one acts on them. Every disaster Credit Suisse faced, from tax evasion charges to Greensill to Archegos, was a flashing red light that management, regulators, and investors saw and ignored. Recognizing problems isn't enough. You have to actually fix them. Takeaway 3. Modern banking's complexity is a feature, not a bug. It obscures risk and prevents accountability. When banks become so complex that even their own executives don't understand what's happening, disaster is inevitable. Here's your warning. The forces that destroyed Credit Suisse are still operating throughout the financial system. Other banks face similar pressures, similar incentives, and similar cultural dysfunction. The next Credit Suisse might already be in crisis. We just won't know until it's too late. If this deep dive into financial history opened your eyes to the fragility of our banking system, hit that subscribe button. We're breaking down the systems that shape your world, one shocking story at a time. Drop a comment. Which bank do you think is next? and share this with anyone who still thinks their money is perfectly safe in a too-big-to-fail institution. Because now you know, nothing is too big to fail.